Hi guys, thanks for tuning in. So today, as I said, I wanted you to look at chapter 1 with me. Chapter 1 is really short. It goes over some of the really key concepts of accounting, what we call the accounting elements, and also it goes over really why we do accounting and what the process of accounting is. And it kind of goes to show you just how important accounting can be to businesses, to individuals, things like that. These will be skills at the end of the day that you can apply to your everyday life. So let's go to the slideshow. So we're looking today at, first off, the process of accounting. Now, the process of accounting boils down to a few key steps. The first is gathering financial information. When we think of financial information, this is everything that business could possibly do in a day that is related to money. This could be hundreds and hundreds of little things. And most people aren't going to want to keep track of all of that. Or when they go back and say, hey, is my business doing well? They're not going to look at thousands of transactions and say, yes, based on all this information, it's good. So what we do as accountants is we try to record this information. And once we've recorded it, we put it into financial reports. Okay? Now, these reports are condensed, usually only about 1 page, and they allow us to actually have a really strong view of the business and how the business is performing. So, as I was saying, key terms of accounting. The first thing that we're looking at is our assets and liabilities. When we think of an asset, we're looking at an economic resource under the control of the business entity. Now, this could be a vehicle, it could be equipment, it could be cash. It's anything that, any resource that the business expects to be able to use to generate future economic benefits. And by that, what we mean is anything that we expect the business to be able to use to generate cash, to make sales, things like that. The other thing is liabilities. Liabilities are present obligations of the business to transfer economic resources to another entity. Now, what we mean by that is the business has an obligation or it has to fulfill this, and to transfer an economic resource is usually to pay them. Okay. Now, a good example of this is a loan of some kind. The next key term is what we call owner's equity. Owner's equity is the residual interest that an owner has in a business once the liabilities are subtracted from the assets of the business. Now, that's a really complex sentence there, but what it means is once a business has paid off all of its external obligations, whatever is left belongs to the owner. It's their interest in it. It's the leftover interest in it. Now, we might also look at this as what the owner has contributed to the business and what they deserve back. So, the reason we use this definition of the residual interest the owner has is because it helps us understand the accounting equation better, which is something we're going to look at a lot more when we start looking at balance sheets soon. But the accounting equation is owner's equity equals assets minus liabilities. So you can see we have our owner's equity being equal to the assets less those liabilities, which leaves us with our residual interest. Now, you can always rearrange the accounting equation to be A equals L plus OE or L equals A minus OE. Pretty simple rearrangement there. But at the end of the day, it shows that there's this relationship. Okay? So, as I said, you can show it like that. Now, the last two accounting elements that we're looking at are revenue and expenses. Revenues are inflows of resources that usually result in the increase of assets of business. Sometimes it can result in a reduction of a liability. Now, they have to be gained through the provision of goods and services to a customer, or usually are gained through that. And they always have to increase the owner's equity of a business. Okay, so if I make a cash sale, that's money flowing into the business, and that's money that if I don't have to pay off a debt to anyone else, goes to the owner. So therefore, it's increasing owner's equity. It's a revenue. Expenses are the exact opposite. So expenses are a loss of economic benefit that usually is caused by a decrease in assets. Now, this could be wages, advertising, any sort of expenditure where we have to pay cash or an asset loses value, things like that. Okay? And expenses will always decrease the owner's equity of a business. The changing of owner's equity is a very key definition. So if it doesn't have that, it's not a revenue or an expense. Again, it's something that we'll look at in greater depth later on. Now, net profit. We simply define net profit as revenue less expenses. And that's measured over a specific period, whether it's a month or a year or 6 months. It just depends. But we call that time period our reporting period. Okay? So the reporting period states a start and finish date, over which we measure profit and other things. So we use these periods in order to measure performance. If we don't have this and we try to measure performance over the life of a business, it can become really messy and it's kind of hard to figure out. So when we look at accounting in the real world and how it's applied to the real world, we need to think about what information is needed, because all accountants are trying to do is to turn financial data into actually useful information. If we can make useful information, it means that people will be able to make better decisions, and this is something that even individuals can use. Now, if you're looking at chapter 1, there is a case study on page 4, and it shows how the business relies on accounting information. So I'd like you to look at that, please. As part of doing the theory questions, you'll have to do that anyway. If you don't have the textbook yet, I will be providing a copy of this chapter, by the way. Now, as you continue your studies, always remember that accounting is relevant to everyone and everything. Every time you buy something, you are making some sort of data that is going to be accounted for. If not by you, then by your bank, or by the shop that you buy something from, the place that you work at. Every time you get paid a wage, that's accounted for. Every single thing you do when it comes to money is involved in accounting. So, wrapping up chapter 1, first thing that you need to do is I want you to make a summary of what we've gone over in this video. Doing the definitions is going to be very key. So, look back at the first page and make sure that you understand all of those learning objectives. And now it's time to complete the check your understanding questions and the end of chapter activities. There's only a few this time around, so this is going to be a really short chapter. I'm not going to place an end card, but join me next time for chapter 2. No. Have a good night, guys. Bye.